Hello and welcome everyone to the webinar. Thanks for joining in. I'm Abhijit Awasthi and I'm going to be the moderator for the session. And in this session, we are going to talk about a lot of things pertaining to the markets, but primarily about the impact of tariffs on the global economy and the markets. And to discuss the same, we have two very seasoned personalities from the markets domain. Uh, who are going to discuss the same with us. Firstly, Mr. B. Prasanna, who is head of global markets, treasury sales, and research in ICICI Bank. And along with him, we have Mr. Pankaj Pandey, who is head of research at ICICI Securities. Welcome, Prasanna. Thanks for joining in. Welcome, Pankaj. Thanks for coming in. So we'll start the session now. Prasanna, my first question comes to you. And before we come to the topic of tariffs, I wanted to talk about this very hot topic uh, about the Middle East hostilities which are going on. My question is that do you think that these things which are playing out in Middle East are going to have a long-term impact on global growth and maybe the overall global inflation, particularly in the long term, owing to higher oil prices? And one follow-up to that would be that do you think that there will be a list of countries or list of economies which will come out as a winner owing to that, and some countries and economies will be on the other side, that is on the losing side? Prasanna.
Yeah, thanks, Avijit. And on my behalf, also let me welcome ICICI customers from all across the world. Yeah, it is really a funny world. Currently, there are really four wars which are going on at the same time. If you have to include the trade war, the Russia-Ukraine war, which started in 22, and we all thought it's going to be a short time in which it's going to end. And now we have this Israel-Iran war, which is actually threatening to get US and Russia involved in it too. So the size and the intensity of the whole thing becomes very big if it happens. Hopefully, it doesn't. And also, we have at the background the Israel, Hamas, and the Middle East uncertainties, which are relatively now looking just like a skirmish and not like a war. But nevertheless, bad for humanity will be, and well-being, nevertheless. But being a very important determinant of what's happening in global assets, we have to discuss all of these. So I think the impact of all of this from a purely from a markets and an economy perspective, primarily the channel is going to be commodity prices, and within commodity prices, the channel is going to be oil. And of course, also the fact that there will be an uncertainty premium that will come into most market or most asset classes, and that will have its own implication. We can discuss that. But on the concept of commodity prices and oil, I think, Abhijit, you will realize that the world is now becoming much less dependent on fossil fuels, fossil energy as one of the sources of fuel. But nevertheless, it will have an impact in terms of higher. I mean, it's much better than it was a few decades back. But nevertheless, it will lead to higher oil prices. There was already an impact in terms of lower growth and higher inflation that we were thinking about the tariff. Now you have this Iran-Israel war as well coming into picture. So to answer your question on who are going to be the winners and who are going to be the losers, I think broadly the way you need to look at is consuming countries which have commodity consumption as a significant part and also which have high current account deficits, those countries will be the losers, and producer countries which actually produce, whether it's oil or even any other commodities, will benefit. And the corollary to that would be that the currencies belonging to the consuming countries will benefit and will not benefit, will actually lose, and the currencies with respect to the producing countries will actually appreciate. Now, the other important factor is that there have been estimates which says that roughly a dollar 10 increase per barrel in an average price impacts growth by around 0.2 to 0.3% at the overall headline global growth level. But this impact, I must say, is asymmetric, and you will have oil consuming countries, like I said, impacted much more than oil producing countries. The other estimate is on the inflation front. There is an estimate which says roughly for every 10 barrels of $10 per barrel of increase in oil price on an average, the CPI inflation goes up by 0.4%. But the magnitude of the impact also depends upon how long the oil prices would remain elevated. So like I said, the average is for the 10 for the whole year. If the conflict is short-lived, the impact will be modest. But if it prolongs for a long period of time, then the impact will be much more pronounced. One other thing that you need to note, which also is important for people to consume and understand, is that Iran exports around 1.5 million barrels per day. It produces around 3.4 million barrels per day overall. But OPEC has a spare capacity of nearly 5.5 million barrels per day, primarily resting on countries like Saudi Arabia and UAE, who can actually increase the supply from their own production if Iran's supply were to, get negated. So that is a point that is a little bit positive over the medium term. But I think the single most important thing which can impact oil prices is not the barrels per day which is being produced in Iran, but whether the Strait of Hormuz, which is the most significant conduit or the strait through which nearly 20% of global oil supply flows through it, if that is stopped by Iran because it borders Iran, of course, it also has Oman as a border. But if it is stopped by Iran, then that can have a far, far bigger impact on oil price. But also bear in mind here that in the past 30, 40, 50 years, whenever any kind of a skirmish or a war has happened and the threat of this trade being closed by Iran happened, they've never done it because if they do it, it probably impacts Iran the maximum. So the hope and we all pray that that does not happen because if that happens, oil can as well go to $120. That's some of the estimates. Now, coming to India very quickly, I think the broad story is for India's current account deficit to widen because of the oil price increase. Inflation will increase and the currency is likely to depreciate. For instance, estimates again in India, it is that around for every $10 increase in the average price for the whole year, it can lead to a 0.3% increase in current account deficit as a percentage of GDP. It can increase inflation. Direct impact will be around 15 to 20 basis points, indirect by another 10 to 15 basis point. And also, government's fiscal position is something that can be impacted if the government chooses to absorb some of the impact and not pass on the higher oil prices. Current levels of oil price is not a problem. We are still pretty much above it. But if oil were to go to 100, 90, 100, 120, then I think government would have to take a call on what they want to do with it. And along with all this is the medium-term positivity that India's renewable energy is also very high. I mean, the thrust on developing new renewable energy source is very high. We have put nearly 30 gigawatts of renewable capacity just last year. So the oil intensity of India's economy is also coming down. We've done some analysis which showed that over the last 10 years, our oil intensity is down by nearly 28%. So we are that much less affected by an oil price increase as we were earlier. But so in summary, I think oil and its impact will be at the forefront of all the impact analysis. And bear in mind that the longer the duration, the higher is the impact on uncertainty, which will then lead to higher risk premium for bonds, equities, and hence tighter financial conditions, which will itself have its impact on lower growth and higher inflation. Back to you, Avnish.
Thanks, Prasanna. So, as I understand, that you don't see a very even if the war prolongs or if it intensifies, barring the situation where the Strait of Hormuz is put out of bound for all the shipments and all, we don't see a catastrophic kind of an impact of this war, given that we have a renewable energy coming up and all the economies are more are trying to move away from fossil fuels. Correct.
Yeah, so that's a medium-term positive, not necessarily a positive for the next 10 days, 20 days, 30 days. But
Okay.
you can take heart from the fact that despite all of this happening, oil has just come to 75, 76 and not really crossed 80 or 90. And I think that can happen only if the Strait of Hormuz is blocked. But till that time, I think market has shown maturity, maybe in the ability of the market itself to handle it, or maybe they feel that it will not spiral into something more worse.
Okay, thanks. So, Pankaj, coming to you, my question is on the same topic, but with a slightly different flavor. So, given that as Prasanna said, that there are multiple wars going on in the world right now. Do you see that all these geopolitical tensions point towards increasing spend on the defense space? And are there some opportunities, at least in the Indian equity market, to play in that space? And if there are further sub segments also over there?
So, I believe, yes. So, for example, just to highlight, Indian equity markets have made a low in the month of April, and from there on, the benchmark index is up about 15 odd percent. But a sector like defense is up about 80% in that time frame. And there are a lot of structural changes which we are sort of seeing in a sector like this. Now, overall, this is one of the few sectors where the expectation is the earning growth is expected to be in mid to high teens for the next 5, 6 years. And also, there are structural changes happening. So, for example, one stage before ordering and tendering is the stage of acceptance of necessity. In the last 3 years, the acceptance of necessity has been given to defense procurement worth nearly about 110, $115 billion. And whereas something similar number happened in the last previous 10 years. So you can imagine the kind of pace at which things are sort of changing. The other perspective is that we are seeing a lot more indigenization, especially on the domestic side. So no longer we are buying too much of equipment from outside. And I think the overall sense what you get even from the government is that at this point in time, we spend somewhere about 1.9% of the GDP on defense. And Defense Secretary spoke about taking it to about 2.5% in the next 5 years. So Indian defense as a segment is definitely doing well. Now, coming to global perspective, what we have seen is that last year, the overall, according to one report, the overall defense spending was one of the highest at about 9.5%, about 2.5% of the global GDP. And this is the highest number which we have seen in the past, say, 20 years. And we have seen big economies like US, China, Russia, Germany, all of them sort of increasing their defense spending. In fact, a segment or a region like Europe, which is somewhere spending about 2% of their GDP on defense, is expected to take that defense spending to about 3 to 3.5%. And all these incidences, the recent geopolitical tensions, especially Russia, Ukraine, or Iran, Israel, and even the India-Pakistan, what we have seen, I think is going to sort of increase the importance of this particular segment. And we have already seen a price performance. So at this point in time, with 85% kind of a rally in the last few months, you pick any defense segment or any sector, any stock in this, it's trading closer to 50 times on a forward basis. So from a medium-term perspective, wouldn't suggest any sort of exposure in a segment like this. But overall, the longish view is that this is one of the few sectors where we are going to see earning growth of mid to high teen, and with good profitability and overall chances of the spending going up, because this acceptance of necessity, which has been given to about 110, $115 billion worth of projects, is going to get converted into orders in the next 3, 4 years. But yes, a lot of this is there in the prices. But yes, any kind of a consolidation and correction would be an opportunity. What is looking interesting in defense is the segment called electronics. Now, defense is no longer a segment which involves largely a mechanical equipment. It's a lot more high tech, and which is why I think wherever segment which is using more of electronics, I think is going to be finding more favor. And so that is the category or the sub-segment what we like in defense. But we are seeing structural transformations happening in the domestic defense and also the global changes which is happening. So overall, I think defense is going to remain in vogue for a good period of time.
So, Pankaj, as I understand that, so obviously within India, the defense companies which will supply to the Indian government needs will obviously be one segment which will do well. But do you also think that with, as you said and pointed out, that globally, like in Europe, they are increasing their spend from 2% to 3.5% of GDP. So do Indian companies also stand a chance to supply globally, or that will be limited to mostly the Indian requirement?
See, overall, Abhijit, our sense is that India is seen as a key manufacturing partner. So, which is why our sense is that you will see a lot more tie-ups or JVs happening both on the civil side and also on the defense side. Given the fact that India offers good amount of talent, especially aeronautical engineers and all of it, the entire ecosystem to sort of take this overall partnership to a higher level. And I think what we have clearly seen in the India-Pakistan recent issue is that India has been able to sort of the way India has been able to sort of integrate a lot of different defense platforms into single one. I think that has been the sort of highlight, and which is where I would want to believe that India is going to be seen as a key manufacturing partner, not from a skill perspective, because that is an obvious advantage we sort of carry. And also from the perspective that India offers a pretty low cost advantage, even in the defense side, compared to a lot of other global counterparts. So I see India emerging not only as a domestic oriented segment, but also as a segment where the export as a leg is going to go up. I think the government is clearly highlighting a mid-teen or a high-teen kind of a growth even in the defense exports as well.
Thanks. So now I'll come to the topic with which we started, that is on the tariff side. Prasanna, my question to you is that given what the kind of turbulence which we saw around the Liberation Day in start of April, and we are coming to close to the deadline of 90 days around 9th of July. So do you think that whatever has happened in the intervening period, do you think that US government is going to uh, give us a softening on their stance? And if that softening is expected, then how will it impact the US and the Indian economy?
Yeah, I think the first thing is that the noise level from tariffs, if I may use that word, is I think peaked. And going forward, incrementally, the news is going to be much less negative than what it was in the past. And the markets have kind of, because of the uncertainty, discounted the worst. I mean, that is not to say that the markets can only rally from here on, but just to say that the kind of things that happened post the Liberation Day, including the Liberation Day itself, has been kind of never seen before in geopolitics, foreign policy, economy, trade, markets, you can see. So I think there has been a lot of back and forth with respect to tariff. There was reciprocal tariffs which was announced. There was a universal tariff of 10% which was applied. There was a pause on the reciprocal tariff. Then there is Chinese tariffs which was put at 145%, then reduced to 30%. So all of this have been done primarily with a tool to either negotiate or to open up further negotiations for trade deals. So you put in a high number, then you reduce it and say that I'm opening it up the period for some time for negotiation. But interestingly, I think it's not so simple to say that tariffs are only being used for negotiations. I think the way to look at it is there is 3 or 4 broad uses which I think the US government is looking at. One is how do you bring reshoring and manufacturing back to the US? And clearly they want to make things more attractive to manufacture within America than outside. So that is, so it seems like tariffs is a slightly a longer term tool than just a tool which is used for negotiating and then do away with it. It doesn't seem to be the case, but the rates can come down, yes. The second important reason is diversifying away from China. Of course, this is also a part of the reshoring manufacturing to the US, but not necessarily from all other Asian countries as well, but typically from away from China. So I think to that extent, the focus of the trade war going forward, China is going to be at the center. The third tool is also raising revenues. I mean, everybody has read about the big, beautiful bill and the fact that US fiscal deficit is hitting the roof at 6 to 7% of GDP, and so much of incremental debt is going to be created over the next 2, 3, 4, 5 years, that it does seem that tariffs are also going to be used as a tool for raising revenues, and there can be substantial amount of money that American corporates will end up paying to the US government if they have to continue importing goods from countries where which attracts an import tariff. And then the last is reducing the trade deficit. So by virtue of producing more within America, the tool, of course, is to try and reduce the imports, which in case improves the trade deficit. So I guess the long-term or the long-standing problem of the US has been a higher fiscal deficit and a higher trade deficit. And I think tariffs is being seen as a tool to look at solving both these problems. The way they have been going about doing it, you can quibble with them, but I think the objective is pretty much laudable, I would say, but whether it's going to get the desired impact is something you need to figure out. So I think, yeah, by the way, different countries have picked up different kinds of speeds. US-China headway talks are limited. The rare earth minerals issue surfaced, so that has kind of put a spoke to it. Negotiations are still ongoing. US-Europe negotiations had picked up speed after the president threatened to raise tariffs, but then the new conflict in the Middle East has taken the front seat, and nobody is now talking about that. And then if you look at the US-South Korea deal, they have made some progress. US-Canada has made some progress. US-Japan has made some progress. Interestingly, most of the current account surplus countries with which US is making the trade deal, there is also speculation that the part of the trade deal will include their local currencies to appreciate a lot, which these countries seem to be resisting. So there seems to be different countries with different. So it's a maze of development and geopolitical news. Very, very difficult to keep track of it, frankly. So I think best to let it settle. And imagine if we are having so much of difficulty, imagine how much problems, producers and people who are setting up factories in different countries will have, because they will have no clue where to set up their new factory if they don't know the tax rates which are going to place. So net, I think our base case expectations will remain that the US opts for a tariff framework of at least 10 to 15% additional for most countries. China will see probably 30 to 40% because that is at the center. And this will give rise to an average effective tariff rate of close to 15 to 20% overall, which was around 3% pre-liberation day. So this will definitely lift up the inflation expectations from goods in the US and in the US, and it might have a salutary effect rest of the world. But weakening demand is also expected to bring down core services inflation. So this is as far as the global is concerned, the impact of tariff. Now, when you look at India, I think more integration with the US will be a big positive for India. It will help India gain a lot of market share. Especially with the other countries having higher tariffs. And but India's exports to the US is only around 2% of its GDP. So there is nothing that we need to fear as much as some of the other countries like Vietnam and South Korea and Taiwan and all that, and China. And so we have been seeing India's exports to the US rising, but it's more like a front loading of things which are happening. We need to see how things are going to be to go on from there. So if you have to think about impact of growth on India, I think India is predominantly a domestic-led growth story. And now with RBI policy also easing, you have anyway, rural was already firing. Now monsoons are going to improve the rural demand. Tax cuts, which was announced in the budget, is likely to improve the urban consumption. Now with the RBI policy easing and EMIs coming down, further consumption can improve. GCCs have been showing fantastic growth with software exports doing very well. They are at the core of job expansion, and they're supporting domestic consumption. So I think net India's growth we still see in the region of around 6.5% in FY26. Within that, electronics will be a very key beneficiary because the trade deal will imply a lot of things with respect to electronics, phone manufacturing, and so on and so forth. And in general, I think there's a lot of complementarity with respect to between US and India with respect to imports and exports, and also with respect to flows of FDI and FPI. So I think there are also a lot of flows which can, especially in the second half of this financial year, when the dust on the geopolitics kinds of settles down. So again, net, I know it's a long answer, but net, I think that tariff is a way to deglobalize. Deglobalize is negative for everybody. So it's a kind of race to the bottom. But the countries which were benefiting from globalization maximum, against whom the tax rates are going to be higher, are the countries which will lose a lot. South Korea, Taiwan, the East Asian tigers. whereas countries like India with a lot of imports, with a lot of domestic consumption-led growth are likely to, kind of get impacted much less. But nevertheless, the slower global growth will have its impact on India as well. Maybe the RBI policy hasn't done enough to compensate for that, and maybe done more is something that we need to wait and watch.
Yeah, that, yeah, thanks, Prasanna. So as I understand that the countries which had a very lopsided current account situation with US are going to be impacted more. Much less for India because, as you said, that it is only 2% of our total exports going to US, and we are at least for now saved from a major impact. Pankaj, my question to you on the same topic would be that with these tariff negotiations going on and possibly we'll have some kind of resolution coming in some days, there are specific industries which are going to be particularly impacted, either side of the trade deal which gets signed. There, if you can choose one or two, the specific industries which are going to be impacted the most.
So, Abhijit, there are still a lot of unknowns. So, for example, we still don't know the percentage of tariff and also the time when it is going to be levied, whether it will be unilateral. But like Prasanna highlighted, we are not a major exporter of merchandise goods. Largely, we export services. So, from that perspective, Indian economy is relatively resilient from this overall tariff challenges. But one sector which is already sort of witnessing the pressure is the technology from a negative side, because what has happened is that this sector, from a price performance perspective, is down about 16, 17 odd percent from the highs. And see, this sector used to deliver a dollar revenue growth of about 7 to 8 odd percent. And then you had currency depreciation of 3 to 4 odd percent, which used to happen. And that is how this IT as a sector used to deliver a low double digit kind of a growth rate. But what you sort of get sense now is that there is most of the commentary what you pick from companies is that there is a client level budget cuts which is happening. Then, since the equipment cost is expected to go up, so a lot of these transformational projects are also sort of taking a back seat. So IT as a sector is clearly witnessing challenges of its kind, and which is why the growth rates have halved. And not only that, even there is a transformation going on in terms of low cost jobs being done by AI. So from that perspective, IT is clearly a sector which is witnessing a negative rub-off of the US scenario. And I think till the time US economic growth is not very clear, or the direction is not clear, or in case if the inflation remains high, then I think IT as a sector is expected to suffer. But there are some sectors which are expected to sort of do positive. So pharma is one of them. We do about $9 billion kind of exports, and 40% of the generic volumes in US is supplied by India. Now, yes, there is a concern that companies will be asked to manufacture in US, but overall sense what we get is that the cost of manufacturing about 1,000 tablets in US is going to be 5 to 6x of what could happen in India, and it's a segment where we are already seeing good amount of price intensity or competition. So from that perspective, whatever hike will be there will be passed on. So I think that is one segment which is expected to sort of do better, according to us. The other one is auto, and again, auto you have different segments. So for example, in auto OEM wise, we don't really export cars or SUVs. What we export is again on the auto ancillary side. So we export forging components, we export tires, engine components. So I think that is a segment which will be impacted directly, indirectly with because of tariff. Because if the US economic growth slows down, obviously the demand for these products will come down. And on top of it, if there is a tariff which is levied, then the overall growth could be impacted. Metal, I really do not see much of an impact, because I think of the Indian entire steel exports, 2% goes to US. For aluminum, it's slightly higher at about 10 odd percent, so that will not matter. I think textile is expected to be a beneficiary because overall sense is that the tariff on India is going to be about, as of now, is going to be about 26%. Obviously, we don't know what will be the negotiated rate. But the countries which are competing with India attract a higher tariff. So, for example, China is attracting 50% plus, Vietnam 46%. And then you have Bangladesh also, which is 37%. So all these are three major exporters. And we have a good cotton base as well. So cotton oriented textile products is something where we would have a natural advantage. And I think on the capital goods side also, overall sense is that we will see better growth compared to what we see from other countries, because China already the tariff is in excess of 50%. Indian tariff is somewhere about 14 odd percent. I think capital goods in select segments, I think things are positive for us. And like Prasanna highlighted, electronics is another segment where China plus one strategy is working, especially in mobile phones. So there we have a cost advantage, and also China plus one is expected to diversify or rewire the supply chain. But net in most of the categories compared to major competing economies, we feel that there is a tariff arbitrage working in our favor. So whatever sectors I highlighted, except for IT, pharma, auto, metals, textile, capital goods, and electronics, I think these segments should benefit from the overall tariff negotiation as and when they pan out.
Thanks, Wagit. So, as I understand that, whatever way the negotiation pans out, on an overall basis, India and these particular sectors, as you mentioned, the pharma, auto, metals, textiles, and capital goods, would be the beneficiary of the ultimate agreement which gets signed. So moving on, my next question to you, Prasanna, is on the Fed and FOMC. So I remember there used to be the time when the only thing in town to watch out for used to be Fed. This was an era prior to all these geopolitical tensions, which have now gained all the highlight. So we just had the Fed meeting this week, and the texture of the meeting was that Jerome Powell still looked slightly concerned about inflation, and this was slightly, if you can, borderline hawkish policy. So. Do you think that rates in the US will remain elevated for long, and what is your view on the terminal rates? And and a follow-up question to that would be that do you think that this would percolate into some kind of impact on Indian rates also? Prathana, you are on mute.
Yeah. So along with the geopolitical discussions and what people are looking for, people are also looking for to what is happening between Mr. Powell and Trump. And that's a very interesting tussle which seems to be going on, where currently Powell seems to be winning, but maybe Trump will win in the next year. And by that, I mean that he's wanting to, change the president, or he's been wanting to get the president wants to change the Fed chair or wants him to cut rates, but he's not playing ball. But beyond that, I think clearly, yeah, the Fed is still quite hawkish. They are looking at policy for them to even looking at cutting rates when this kind of a scenario of higher inflation is happening everywhere due to tariffs. But the saving grace seems to be that it's a one-off effect, so they can possibly look through it. That's one. Second thing is, even after 2 to 3 months of tariff being imposed, we haven't seen it flowing through into inflation as yet. So there is still a possibility of the Fed cutting rates this year. And as they themselves have indicated, nearly a 50 basis point cut in policy rates this year, and a cut in the next year as well. But there has been a lot of divergence opinion amongst the Fed members. And even yesterday or day before, we have seen one of the Fed members now talking about the need for the Fed to cut rates in July. So it's not a simple case anymore. There's going to be a lot of debate. There's going to be a lot of divergence of opinion. They have indicated through their dot plots that they'll cut 50 this year and they'll cut next year. But I think we believe that there can be space for 50 basis points of cut in 2025 as well as in 2026. And I think from the perspective of bond deals and all that, I think the way to look at it is bond yields are impacted by what the Fed is doing as well as what is happening on the fiscal and the supply factor. And from that perspective, the fact that the fiscal deficit is very high and incremental debt issuances are very high, there is an expansionary fiscal policy, means that there will be very limited room for long-term deals to, come down. So that is why I think you can see some kind of a steep yield curve in the US as well. And also bear in mind that demand from foreign central banks doesn't seem to be going up. And in fact, people expect that to come down as we go forward, even if it doesn't go up. So I think that's where we are. And incrementally for India, what it means is that if you have to assume that there is not much space for the Fed to cut beyond 50 basis points, and there is not very limited space for bond yields to fall this year at least, then I think the extent to which RBI's rate cuts can happen is also going to be limited. As it is, he's used up all his space available at this point of time, and any incremental fall in growth vis-a-vis the trajectory, incremental fall in inflation vis-a-vis the trajectory is what can, engineer another rate cut from the RBI. And if differential interest rates are going to be as low as what it is, we are seeing the differential yield being just around less than 1.8 to 1.9%, not very attractive for a non-Indian investor to invest into Indian bonds, then it feels that, Indian bond yields also might not find it easy to go down if the forward-looking carrot of a rate cut down the road is not there. Bear in mind that the RBI changed its stance in the policy. I mean, the policy was super bullish for the economy, for the real economy, for the banking system with deposit rates getting cut and transmission happening. But it has not been good for the bond markets because bond markets always discount everything in advance. And we all expected a 25 basis point cut with a forward-looking 25 basis point cut to continue, more accommodative stance to continue. All of them did not happen. In fact, all the 50 basis point cut happened and the change in stance happened to neutral, which turned out to be negative. So I think duration that is more than 5 year, 7 year bonds in India might not be too attractive from a medium term perspective. There might be tactical plays where you can enter and exit over a 15-day, 20-day period. But the earlier aspect of, the cycle has turned and it's going to be easy for a long period of time is simply not happening. So from that perspective, it is a short end in India, which looks good. And so that's where we are from a bond yield and from the RBI rate cut perspective.
Thanks, Prasanna, for pointing out that the divergence of views between the Fed, which was like extremely conservative in their approach, saying that they'll wait out to decide, and yeah, okay. Yeah. Uh, so, uh, so I was saying that, as you rightly said, that there was a divergence of the approaches which have been taken by RBI and Fed, between Fed. RBI was extremely bullish in firing all cylinders, right from the cut and the stance, and as well as the CRR cut which they announced, and Fed on its own was very conservative about what are they going to do in future. Pankaj, my question to you is on a similar line. As Prasanna said, that there is an expectation that the rates in US are expected to remain up. Maybe the long term yields are expected to remain up in US. So would that have an impact on Indian equity markets in general also, because the kind of return which someone the capital which is sitting in US can earn in India will be slightly calibrated? Do you see that there is a broader impact on Indian equity markets of that differential?
So, Abhijit, what we are clearly seeing is a divergence between.
We can see him.
So Abhijit, what we are clearly seeing at this point in time is a divergence of interest rate between India and a big economy like US. US is still sort of seeing a higher inflation and expected to see a lot more higher inflation in the going days in case if the tariff levels or the tariff rates are higher. Compared to that, the Indian inflation is at a 6-year low level. Last inflation reading was somewhere about under 3%. This again is half of what we have seen in the 6 months ago period. The other factors which is sort of contributing to inflation, something like say crude oil, hasn't really risen materially. Similarly, monsoon is expected to be above normal. Now, when you sort of see a scenario like this, I think the domestic macros look good to us, but the higher interest rate is never a good thing for any economy. So for US, again, it impacts the overall consumption. And but for us, we see a number of positives coming from this, or relatively positive or relative positive coming from this. One is if the US consumption takes a sort of a back seat, overall sense would be that you will see a lot more FPI inflows happening both on the equity side and also on the debt side, which means that the Indian cost of capital can come down, which again is extremely positive for markets in general. Because what it does is that it increases the risk appetite of businesses to sort of take on further expansion. The other thing is that overall, if the US does not do well, because what we have seen up till now is that any crisis in any part of the world, US remained a preferred choice for investors, be it bonds or be it equities. But in case of US takes a backseat because of deteriorating macros, then overall sense is that the markets there may not really do so well the way they have done in the past, and which means that you will see a slightly better inflows in a lot of emerging markets. It could be debt, it could be equities. So from that perspective, I think we feel that overall we are going to see a relative positive rub-off coming from higher interest rates in US and relatively lower interest rates in India.
So Pankaj, as I understand that you're saying that the US equity investors or the capital which is lying there, they might not find the US opportunities that much lucrative, and that will lead to a flow of capital into countries like India, which offer a better value proposition. Correct?
Absolutely, because see, up till now, or for a good period of time, Abhijit, it was considered that US is an exceptional market. Their equities have been doing very well. Even now, also with all this issue, it's closer to 52-week highs. Now, in case if the inflation is there going to be higher, then consumption categories, probably asset quality concerns also might come up with higher interest rates, especially on the banking side. So overall sense is that this exceptionalism of US is at risk at this point in time, which means that relatively it is positive for emerging markets. And within emerging markets, while we believe that overall a lot of other markets are also doing well, but India relatively on a growth front is doing one of the best. Also, from a macro stability perspective, or most of the macro factors are in favor. So, which is why I feel that US not doing slightly better is good for emerging markets. It should not do too bad because that will sort of then unfold chaos. So that is a bigger risk. But our sense is that in case if it is a slowdown which can be sort of managed, or a lower consumption which can be managed, it is structurally positive for emerging markets and including India.
Thanks, Pankaj. So my next question to you, Prasanna, is on the Indian rupee. That how do you see the Indian rupee to perform in coming days, given as we have already discussed that India remains in a fundamentally stronger position, and would that be more getting out of or because of the strong fundamentals in India, or that would be because of the general trend of dollar weakness? How do you see Indian rupee performing in the next few months? Maybe both in the short term and the long term.
So I think basically when you look at a currency, you'll have to look at it from the perspective of what's happening to the dollar. and then what is the demand and supply and the macro fundamentals for INR, and then take a call as to whether it's likely to appreciate or depreciate after you take a call on what the RBI will do. So when you look at the dollar index per se, first of all, it's very clear that it's in a depreciating trend. And if you really see this year, dollar index has lost close to 9-10%. Euro has gained the maximum 11, close to 10 to 11%. Pound has gained by 6 to 7%. JPY has gained close to that. And the Swiss franc has also, kind of gained almost 10%. But if you notice that most of the gains are concentrated in the developed market currencies, and when it comes to EM currencies, the gain is limited. Chinese yuan kind of gaining by 1.5-2%. But when you look at countries which are current account deficit countries like Indonesia and India, the currencies have fallen by 1.8% or 1.3%. So I think if you have to look at what's happening on the dollar globally, there is a weakness. You can call it structural, you can call it cyclical. There are enough reasons to define both. There are also, structural reasons like the US high fiscal deficits and the central banks itself, because of the kind of foreign policy that the US is following right now. The need for central banks to diversify away from the dollar to other currencies, including gold, has also taken place. So it does look like it's a weakness in the dollar, which is clearly going to play out and going to play out for some more time. Of course, there will be short periods of volatility, the geopolitical volatility, especially war induced, which will lead to dollar appreciation. But as of now, it looks like those are short-term reactions, whereas the medium-term reaction is for the dollar to steadily depreciate. So within that, like I earlier pointed out, current account surplus. So first, developed market currencies will be benefiting the most with this dollar depreciation. Amongst emerging markets, the impact will be far lesser in terms of EM currencies appreciating. But within EMs, you have to distinguish between current account surplus and current account deficit. The current account surplus economies would probably have a greater amount of appreciation in their local currencies against the dollar, whereas countries like Indonesia and India will face some kind of depreciation, or at least much less appreciation than some of the other counterparts. So I think the long story short is to say that while a lot of non-dollar money is likely to come into emerging markets, where a lot of non-US money which was investing into US is now seeking currency hedges, which is a weakness for the dollar. And while it is also a fact that a non-US investments are now chasing other non-US destinations for investment, like Japanese investors investing in Japan rather than in the US, and so on and so forth. These are all structural, very long-term, medium-term kind of changes which are gradually happening. Within that space, INR has a tailwind from all those developments, but there are a lot of headwinds because our interest rate differential is very low. So we're not getting enough capital flows on debt, not getting enough capital flows on ECBs. We are not getting enough capital flows, at least as of now, on equities, with valuations being very high. There is a lot of selling which is happening. So even on a net FDI basis, we are not getting substantial money. So while current account deficit, we are very, very comfortable at 0.6 to 0.9% of GDP. The capital account is not very comfortable. The saving grace also is that the RER is kind of now fairly valued at close to 100. So there are enough reasons for an appreciation as well as depreciation of the INR. But I guess the single most important determinant will be how will the RBI react. And according to me, the fact that Reserve Bank has a lot of short dollar positions in the forward market, nearly $65 billion, means that when flows come in, RBI will use it to kind of absorb the dollar flow and prevent the rupee from appreciation. So I would have a kind of a neutralish to a marginal appreciation view from especially levels around 87 that we have seen, because that is a lot of war premium that has got built into the prices. So short term, it can go worse because as the Iran-US Israel involvement increases, and short term it becomes most worse. Over the medium term, we could see it coming back to 85 kind of levels, but we don't see it going all the way to 83 and 84, which is what some of the other research houses seems to be putting out.
Thanks, Prasanna. So, Pankaj, coming to you, you have already spoken about this sector once in your previous response. As Prasanna said that there are chances of rupee appreciating to 80, 85 kind of levels, but obviously it is uh, given that we need to understand what RBI will eventually do in the market and how it absorbs any kind of inflows which comes in. My question to you is on the IT sector, which has its fortunes linked with how the dollar rupee behaves. So, from this very currency specific perspective, do you see any kind of green shoots on the IT side emerging, or your view, which you have already given on the sector in a previous reply, that there will be a broader slowdown in this industry, or from the rupee perspective, do you have any other thoughts?
So again, see, IT sector, again, I'll sort of expand the scope and include GCCs. So IT sector, which I spoke about, largely, I would stay with my dollar revenue growth from 7 8 odd percent coming down by half to about 3 to 4 odd percent. Currency depreciation, which used to be about 3 to 4% annually, looks difficult structurally given the better macros domestically. Then there is a potential headwind what we see for clients for this year. But one ray of hope would be that probably FY26 or FY27, 1 year down the line, things might improve for IT as a sector. But where I think things are sort of taking bigger shape is the GCC as a space. We already know that there are about 600, 1600, 1700 corporations who have got their global capability centers in India. And just to sort of highlight how this segment is doing well, you look at the net leasing office activity. So Bangalore has seen the highest net leasing activity in calendar year 2024. So to the tune of about 14 million square feet. Mumbai was about 11 million and Hyderabad was somewhere about 8, and Delhi about 7 million square feet. You look at a city like New York, the net absorption there was somewhere about 7 million square feet. London was somewhere about 3. So I think this is one segment which is clearly sort of doing very well. So if you sort of exclude or don't really focus only on the listed IT space and include GCCs, then the picture looks a lot more better for IT as an overall pack. Because somewhere down the line, I think Indian talent is finding favor within the GCCs, and a lot of these GCCs are not only looking at a low cost center, but also looking at a lot more strategic work or strategic output coming from them. So I think from that perspective, IT does not look negative, but yes, listed space, like I said, will have some challenges for the next 1 year, and possibly a year after things might look better.
Thanks, Pankaj. So, in the interest of time, we'll take two more questions. These questions have been submitted by our clients. Prasanna, I'll like to have your thoughts on how do you see gold as an asset class, or as an asset panning out? Your view on gold. This question has come to us from a client.
Yeah, so I think gold has been a very interesting asset class and has performed fantastically over the last 3 4 years. And our view has always been very constructive on the asset class and now continue to be constructive even though it has rallied a lot. Because there are two things which are going in favor of gold. One is, of course, the rupee price is impacted by both the rupee depreciation as well as what's happening to the gold dollar price. And the rupee, because it depreciates, we kind of get an uptick on the gold price on a rupee basis. Even in terms of gold dollar, I think gold has been a very important asset class used for portfolio diversification, inflation hedge, and the fact that there has been so much of currency printing over the many years that there is a little bit of a less of faith on any of the fiat currency. One very important structural reason is the fact that uncertainty premium increasing always leads money to flow back into gold. So all these geopolitical fears, trade wars are actually feeding into gold bullishness. And the second is that, of course, central banks itself, by virtue of the kind of foreign policy that US has been have led to kind of diversifying away from gold into away from US dollar into gold. And a very recent article which said that now they have the amount of central bank reserves invested in gold has crossed is the second biggest after gold after US dollar and is now crossed euro. So I think from that perspective, that move will continue as long as there is this de-dollarization, which is happening even slowly, central bank diversification, which is happening, and geopolitical concerns always on the increase. Gold will continue to do well, maybe not linearly, but over a medium term, till the time some of these things reverse, I think it will do well.
So from a safe haven kind of a demand, gold will always be glittering as I can understand. Okay, thanks. So for Pankaj, one question which has come to us from an NRI client of ours is that they wanted to understand a little bit on the details of this FTA which is getting signed with the UK. With UK. So if you can, 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 so if you
Abhijit,
can.
to UK market. So bilateral trade is expected to sort of benefit. I think one big beneficiary of the FTA with UK would be the textile sector because whatever UK exports, imports in terms of textiles, India's share is only 5%. Bangladesh is somewhere about 17 odd percent, and China is at about 25%. And India pays on an average tariff in the range of 8 to 12 odd percent. Whereas some countries like say Bangladesh or Vietnam, they don't really pay any tariff. So overall sense is that the India will have a relative advantage, especially in cotton-based textile products, also because of cheap labor and also because of the entire ecosystem of cotton being there. The other segment which could benefit is the jewelry segment because UK imposes about 20% VAT on gems and jewelry, and in gems they have a custom duty of another 2.5%. Now there won't be any levies, so obviously gems and jewelry companies are expected to benefit. And while liquor, people talk that it is going to be negative, but our sense is that India as a market for liquor is moving on the premium side. And with lower import duty, a lot of these imports, bulk imports, can happen of Scotch whiskey and gin. And it can be blended with the premium liquor brands domestically, and we feel it's quite complementary in nature. So that is another segment that should benefit with the UK FTA deal.
Thanks, Pankaj. So with this, we come to an end for the session, and thank you a lot, Prasanna and Pankaj, for this wonderful and insightful 1 hour. I'm sure that our audience has taken a lot of inputs from your thoughts and answers, to which I guess will help them to take much more informed calls. Thanks again, Pankaj and Prasanna. And
Yes.
to all our audience, I thank them for joining us. And just one request from my side, uh, that there will be a feedback pop-up which will appear on the screen. If you have some input and feedback for us, please register the same. Any last thought, Prasanna and Pankaj, from your side before we end the session?
Let Pankaj give a view on the Nifty index for the end of the year. I think that's something the people might want.
So for Nifty, overall our target is 27,000. We would expect in the next upcoming 6 months markets to head to make a new high, largely because we'll see a recovery in the earnings. And I think next 5, 7 years, India is one of the few markets where low double-digit compounding returns can be fetched.
So
Thanks,
we'll close
thanks,
on that
Pankaj.
positive note.
Yeah, we close on that positive note. Thanks everyone for joining. Thank you.